Hello, and welcome to this webinar presented by the IFRS Foundation. I'm Roberta Ravelli. I'm a technical staff at the IFRS Foundation, and I'm your host today. First of all, some housekeeping information. We encourage you to ask questions in the Q&A window on the topic for today, which is making the transition from the TCFD recommendation to ISSB Standards. We might not be able to comment on all questions today, and some questions might be outside the scope of the topic that we are discussing today. But rest assured that we will consider all of them in our educational efforts, including future webinars and communication going forward. This webinar is being recorded and will be available on the IFRS Sustainability Knowledge Hub. We have closed captioning enabled, so you can turn it on in Zoom. Live closed captioning will not be 100% accurate, but we hope it helps with the accessibility of today's content. And another quick disclaimer, the information and topics discussed during the webinar do not constitute implementation guidance from the IFRS Foundation. So welcome to everyone joining live from all around the world, as well as those listening on demand. Here is a look at the demographics of the registrations for this webinar. You can see that we have 2,800, well, over 2,800 people from 119 jurisdictions, including sustainability officer and finance and reporting executives, members of the accounting profession and academia, as well as some consultants. Our topic for today's episode is making the transition from the TCFD recommendation to ISSB Standards. And we will discuss the status of climate-related disclosure globally and how companies are moving to the ISSB Standards. Then some tips for companies making the transition from applying the TCFD recommendation to applying the ISSB Standards. And we will also talk about some transition relief and proportionality mechanism to aid companies as they prepare to provide climate-related disclosures applying the ISSB Standards. Our hope is that you come out of this webinar informed about the latest progress made by companies in the provision of climate-related disclosures based on the analysis of 2023 reports, especially as they prepare to comply with ISSB standards, whether voluntarily or in an increasing number of jurisdictions that are adopting ISSB standards. Links to several resources will be added in the chat as we go along and will be sent to you also in a follow-up email. We will also send you a copy of the slide. So the first link that you will probably see in the chat is the link to the 2024 report on progress on corporate climate-related disclosures that the IFRS Foundation published on the 12th of November. This report includes the analysis of the 2023 reports that I just mentioned, exploring the progress made by companies in the provision of climate-related disclosures. And now let's turn to who will be our speakers today. To lead off the discussion in a moment, we will have Jeff Hales, ISSB board member, who has seen the evolution of climate-related disclosures over the years in his role of Professor of Accounting at the University of Texas at Austin, and in several roles in standard setting, including at the Financial Accounting Standard Boards and at the Sustainability Accounting Standard Boards. He has shared his knowledge when providing strategic input to me and to other colleagues at the IFRS Foundation for the development of the 2024 report about progress on corporate climate-related disclosure. So thank you very much, Jeff, for joining us today. And I also wanted to welcome our guest speakers who will bring expertise from different perspectives, TCFD experts, consultants, and sustainability reporters. Today we are joined by Juan Carlos Belausteguigoitia president of the TCFD Mexico consortium, which was launched in December 2021 to help companies to apply the TCFD recommendation, which are now incorporated in the ISSB standards. We then have Anna Simon, a principal consultant at ERM. She supports companies in their climate risk disclosure and strategy processes, applying international standards and frameworks, including the TCFD recommendation and ISSB standard. And we also have Andrew Van Haght, ESG reporting specialist at Olam Food Ingredients, or OFI. Leveraging his knowledge of sustainability standards and framework, he links finance and sustainability, helping in progressing wider business transformation activities. So thank you all in advance for your contribution to the discussion today. And Jeff, it would be great if we could start with some highlights and key findings on our new report, including the status of climate-related disclosure globally and how companies are moving to the ISSB standard. So would you like to talk to us about that? Thank you.
Absolutely. Thanks, Roberta. It's my pleasure to be here. Thanks for moderating the panel, helping to get us ready for today. And you know, just to give full disclosure, Roberta has also not only moderating this session, but she in a sense was a moderator for all of the work that was going into this report. She was a very integral part of it. So she could answer all of these questions as well as probably any of us. So I just want to give credit where credit is due there. We have a slide maybe we can put up here, yeah, to show some of the statistics. But first, let me give a little bit of context for the report and the data that we're going to talk about here. So what we did in continuing the work that the Financial Stability Board had asked the TCFD Secretariat to do in its previous TCFD reports, you know, we're continuing to monitor the use of the reporting in line with the TCFD recommendations. As probably everybody knows, there are 4 pillars to the recommendations: governance, risk management, strategy, metrics, and targets. That corresponds to 11 specific recommendations. And so we looked at a sample of over 3,800 public companies when doing this year's report. And that's more expansive than has been done in prior years. But importantly, we continue to look at the same industries that the previous TCFD reports had looked at. So that, just to give some context, that's banking, insurance, energy, materials and building, transportation, agriculture, technology, and consumer goods. So, but I think that, you know, although it's a larger sample, I think we can continue to draw some pretty clear inferences from the trends that we're seeing. So looking at the 2023 reports for this year's update, one of the things that we saw was continued progress. I think along basically all dimensions, and yet you'll see from the data that there's still a lot of gaps in reporting in some ways. So some of the things that we see are, for example, 82% of the companies that we looked at in the sample disclosed information in line with at least one of the 11 TCFD recommended disclosures. Now, about 44% of the companies, disclosed in line with at least 5 of them. But when you think of how many companies were actually producing information in line with all 11 of the TCFD recommended disclosures, it was a fairly unusual observation there. So seeing only about 2 to 3% of companies reporting in line with all of the 11 recommended disclosures. If we break that down a little bit, we see that one of the things is, although there are, there's higher levels of disclosure in line with some of the recommended disclosures than with others, we see from 2023 to 2024 increases in the number of companies, the percentage of companies reporting on all of them. So regardless of which recommended disclosure we're talking about, we're seeing an increase from one year to the next in the percentage of companies that are disclosing that information. And where we saw the largest growth was in the greenhouse gas emissions metrics, with about a 10% increase from 2022 to 2023. And then we saw for the next largest increase with the other climate-related metrics beyond just the emissions metrics. And then that was about an 8% increase, and then a 7% increase when looking at like board oversight. So another way to look at this is like, where do we see the most disclosure overall? So where we see the most frequently disclosed disclosures in line with the most frequently disclosed information, that was around greenhouse gas emissions, with about 63% of companies that were reviewed reporting information on their greenhouse gas emissions. The least disclosed disclosure for both 2022 and 2023 has to do with the company's assessment of the resilience of their strategies to different climate scenarios. So there we're seeing, whereas we're seeing like the majority of companies reporting information about their greenhouse gas emissions, it's really only about 1 in 10 companies disclosing information right now about the resilience of their strategies. So, when we look at these trends, it's pretty consistent with what we've seen from the TCFD reports that preceded this particular report. You can also, inside the report, I won't go into all the detail here, but we see variation when you look across different industries, different regions. But I think that the broad trends are all still there. So maybe just to comment on a couple other things. In addition to looking at disclosures in line with the TCFD recommendations, we also took a look to see how many of these companies in the sample were talking about the ISSB's standards. And so we were looking for references there. And this is really important because, as we know, the TCFD Secretariat has been disbanded, and the Financial Stability Board viewed the work that we've done under S2, our climate reporting standard, to be the culmination of the work that the Financial Stability Board had hoped for with the TCFD Secretariat. So we feel it's very important for companies to be able to make that transition from TCFD disclosures to reporting in line with the ISSB standards. So what we're seeing there is, between October 2023 and March of 2024, already over 1,000 companies referencing the ISSB in their reports, and that covers a wide number of regions. So just to name a few: Nigeria, Zambia, Brazil, Costa Rica, Chile, Mexico, Canada, Australia, China, Malaysia, Singapore, Japan, and the UK. And these are all jurisdictions that have already announced plans for the introduction of the ISSB standards into their legal or regulatory frameworks. But we've also seen companies in other jurisdictions, for example, like in the US, where we probably expect more use of the ISSB standards on a voluntary basis. We're also seeing companies in those regions also make reference to the ISSB standards. So kind of a lot of information, but a broad overview hopefully gives you a sense of some of the trends and where we're at right now.
Thank you very much, Jeff, for this insight and for getting us started. So I would now turn to our panel for their views on companies making the transition from applying the TCFD recommendation to applying the ISSB standards. And considering that our panelists represent the different side of the disclosure ecosystem. And as a reminder to our audience, after this initial round of comments from our panelists, we would love to take your questions, and you can add them to the Q&A box in the Zoom tool. So, Jeff, you mentioned Mexico, so I think we can start with Juan Carlos. Juan Carlos, from your perspective, how are companies in Mexico preparing the transition from the disclosure prepare applying the TCFD recommendation to the disclosure prepare applying the ISSB standard? Also considering that, if I'm not wrong, the National Banking and Security Commission in Mexico has proposed to require non-financial companies to use the ISSB standards from 2025.
Sure, Roberta, thank you very much. I first would like to start by thanking the ISSB team for inviting me to participate in the seminar and sharing the experience of the Mexican TCFD consortium. With regard to the transition, I think it should be a smooth transition, given that the IFRS S2 standards are as I see it, a logical evolution of the TCFD recommendations. I would like to touch on four themes, issues to answer your question. Well, I wanted to talk about the global status of the TCFD recommendations, and how companies are moving to the S2 standards. But Jeff already mentioned in quite some detail that, so I will only focus on Mexico. We have conducted a survey for the past 2 years on firms, companies that participate in the Mexican stock exchanges. We distributed the questionnaire among almost 160 issuers, and among them, 60% already report some aspects of the TCFD recommendations, their status with regard to the TCFD recommendations. Out of the 160 companies, as you might imagine, and I think Jeff also mentioned this, the financial sector shows quite more progress compared to other sectors. Although, of course, the level of implementation varies significantly across organizations. Most of the time, the larger and those that have an international connection, BBVA, Santander, etc., are better prepared to report on the TCFD recommendations. We also asked about the challenges, what companies find more challenging, and this also is consistent with what Jeff just told us. I mean, the climate risk management strategy is in general a problem, and in particular, conducting climate scenario analysis. And that's why the Mexican consortium, along with partnering with the Central Bank, the Banco de Mexico, and the Treasury, la Secretaría de Hacienda y Crédito Público, we are conducting a pilot to support 10 financial companies to improve their capacities to conduct scenario analysis, which was clearly identified, as I mentioned, as the main difficult to comply with the TCFD recommendations. As you know, well, moving on to a comparison between the S2 standard and the TCFD recommendations, I think that they are, as I said, the S2 is a logical evolution of the TCFD recommendations, and then there are, of course, differences, but these differences are more refer more to the kind of guidance and details rather than to the core of the TCFD recommendations. There are three main differences, I would say. No, specifically, S2 uses different wording sometimes to capture what the TCFD recommendation already stated. That's the first difference. The second difference is that S2 requires more detail in certain, specifically with regard to metrics and objectives. It has some industry-specific metrics, for example. and it requires enhanced greenhouse, scope 3 emissions, enhanced reporting of scope 3 emissions. And last, the S2 standard differs from the TCFD guidance, but not again from the core of the recommendations, mainly by providing some additional guidance. The good thing about, I mean, some firms may find this or are finding this in Mexico quite complicated, but the good thing is that the TCFD, that the ISSB offers a transition relief, and that comes in several forms. For example, there are there is a very strong support framework that is offered with regard to implementation guidance and educational materials. I'm sure that you have mentioned
exactly.
this.
It's exactly also in our radar. I feel that you cover a very important point that we could ask maybe to the other panelists to explore further, because I think, Juan Carlos, as you said, the findings of the survey that you conducted in Mexico are encouraging, very similar to the findings that we discussed in our climate report. And you also refer to the comparison between IFRS S2 and TCFD recommendation. That is also something that we discussed in our report, and the differences and similarities there are. And on this specific point, I want maybe to ask to Hannah if she can add a little bit of comment on this specific aspect of similarity and differences between the TCFD recommendation and the IFRS S2. And particularly given the role and the work that Anna is doing in supporting companies in the transition, whether she has any tips or suggestion that she can share for companies that are currently doing this gap analysis, maybe identifying some of the points that Juan Carlos was mentioning in terms of aspects that differ and after that are similar between the two. Thank you, Anna.
Yeah, of course. Thanks, Roberta, and I'd be happy to do that. I think if I could think about boiling it down to sort of 5 key tips, the first would effectively be to start with some scoping. So, figure out if you need to report, when you need to report, and decide on your ambition, which might in part be reflected by some of your stakeholder needs. They might also, thinking about what your auditor is asking of you, etc. Adapt your ambition on that basis, and then you've got a good framework to start assessing some of your key gaps. I think, like you've mentioned and like we've discussed already, there are fantastic resources out there, like the comparison table that you mentioned, to really help understand what some of the key differences are between the TCFD and S2. So consult these resources. ERM, the business that I work for, we've also published their comparison table too. There are loads of resources out there to really help you as organizations understand what the key differences are between TCFD and S2. And as you said, Roberta, start with the similarity. So we know that if we think about the governance pillar, looking at S2 and looking at TCFD, they're quite similar. But then some of the other pillars, like when we start thinking about metrics, so the S2 references industry-based metrics as an example, the use of carbon credits. There's some additional information required on targets. So I think really understanding the differences in the first place, comparing the differences between the TCFD and S2 is a great place to really understand how disclosures need to be amended to align. Then moving on, as you as an organization start to do this gap analysis or assess your readiness, be pragmatic in how you interpret the requirements. We've heard already that there are some wording differences, but try not to be discouraged or bogged down by differences in wording. The differences are when you kind of really understand and read the requirements, are actually a little, the differences are a little smaller than they may come across. And also remember that the ISSB standards they only require the disclosure of material information. So when it comes to assessing your gaps and preparing your disclosure, think about this concept of materiality. Not every single line might need a disclosure. Also wanted to say, as kind of a fourth point here, that there's a difference between process gaps and disclosure gaps. And when we support companies to understand their alignment to S2 or to TCFD, in one way, figuring out disclosure gaps is a little more straightforward, because it means opening up a CDP report or an annual report and trying to understand the extent to which your organization actually meets the specific requirements under S2. But then there are also process gaps. So really understanding from an organizational perspective and the processes required for actually making that disclosure, how ready you are to disclose. So in addition to thinking about disclosure gaps, think about the process gaps that go into making an S2 disclosure. So, talk to people from risk, from finance, from sustainability, investor relations, etc. Talk to your colleagues to really understand whether there are gaps from a process perspective, as well as a disclosure one. And then a final point from me is, once you've done this assessment, you've understood the gaps, develop a plan to close them. So, this might involve gathering new data. It might mean improving your reporting processes or developing new ones. Make sure that these gaps that you identify have tangible actions that are realistic, that speak to the ambition that you're trying to meet as a business, and communicate your plan to your various stakeholders that might be involved. So those are my five key tips.
Thank you, Anna. I'm sure that many of the people that are listening have taken note about the 5 top tips on how to approach the transition. And there might be probably many colleagues with an experience similar to the one of Andrew. And Andrew, you also have an auditor background, so you must have a lot of experience in approaching changes and new requirements, new standards. So also thinking about many of our listeners that are dealing with the transition at the moment, what would be your main suggestions for companies that are currently making the transition from the TCFD recommendation to the ISSB standard from your perspective?
Yeah, thanks, Roberta. So I think the first thing I would say to that is that one of the things that I've noticed in particular is that there are quite a few low-hanging fruits, I think, when it comes to implementing ISSB. So, we've touched on, Juan Carlos mentioned there's obviously the foundation is TCFD, and we've evolved and sort of progressed it from there. But there is still quite a lot of overlap. And so it's not a case of reinventing the wheel here. It's starting with what you have, identifying, I think, to begin with, what those low-hanging fruits are, some of the disclosures that you probably are in a pretty good position to make already. It's just maybe a case of, discussing, as Hannah was saying, discussing these parts with other people within the organization, identifying what those data needs are and what some of those gaps might be. And in most instances, I think a lot of companies could fill those gaps relatively easily. Obviously, there are then additional disclosures that need to be made, but I think to start with, identify what those low-hanging fruits are and progress it from there. Putting the auditor hat on for a second, I think the key thing to remember with these disclosures is that you're identifying effectively risks and opportunities, but focusing on the risk element for the time being. You are calling out risks in a fairly substantial way, and from an auditor's perspective, this is a big flashing light for them to say, look over here, look at these disclosures that I'm making, and let's work out what the impact might be on the financial statements. And in some instances, you are going to have material impacts to assets. You are going to have material impacts to your liabilities, potentially new liabilities needing to be recognized. And in some extreme instances, you could even have impacts to an organization's going concernability. And as soon as you have that sort of situation, naturally, the auditors are going to take note and they're going to ask a bunch of questions. And I think building on what Hannah was saying, I like that concept of process gaps, because the key thing here is you've got to understand where those gaps are. The auditors are going to be coming, they're going to be asking a bunch of questions, and the best way to get ahead of that is to identify what those questions might be, make sure you have the processes in place, you know where your data is coming from, you have the ability to back that up, And I think engage with your auditors early on as well. This shouldn't be a process that you're doing in a silo. I think working closely with your auditors, understanding what the impact could be with the financial statements. Effectively, we've treated these as non-financial disclosures for a lot of time, but there's a reason why it's the Task Force on Climate-related Financial Disclosures, because there is obviously a close linkage to that. And so I think bringing your auditors in and discussing this with them as early as possible is a big way to enhance how you get these disclosures over the line.
Thank you very much, Andrew. And thanks to all our panelists for those comments to set the scene. And I think we can maybe now take some questions from the audience. I have to say, just monitoring the question that have been submitted, probably in these initial comments, you have already answered some of them. For example, some people were asking suggestion on how to deal with the challenges in moving from the TCFD Convention to the ISSB standard, and I think both Anna and Andrew, you covered that, and also Juan Carlos, when you mentioned which are the aspects that offer room for improvement in your survey in Mexico. You also mentioned that there are tools available, educational material, there are initiatives helping with that. But maybe starting with one question, probably for Anna, given that it covers different sectors. We have one question asking whether there are any sectors that you have observed are maybe more advanced in making the transition. Maybe, I don't know, industries that are traditionally more focused on climate risk. I'm just guessing. Would you have any comment on to help with this question?
Sure, and it's quite a straightforward question, but there's actually quite a lot to unpack. Of course, how we answer this and approach the question would vary by source, and actually what it means to be advanced. Are we talking here about the quality of a disclosure, the coverage, or both? I think we would kind of expect that in certain geographies, disclosures tend to be more advanced, of course, in preparation for mandatory reporting. So, for example, we know that in Europe, we have some of the kind of highest reporting rates for TCFD. But if we're talking about sectors, we think about the general maturity of TCFD-aligned disclosures. Those that tend to be more mature in terms of aligning to the 11 recommendations are insurance and energy, generally speaking, but that might vary again by source or by geography. And there could be a range of reasons for this. There could be, stakeholder expectations. There could be some specific sector-based regulations that are driving or guidance that's driving that maturity. Of course, keeping up with peers. If for example, in a sector there's just generally high maturity, then there's, sort of pressure on companies to meet that level. But then also, as you were alluding to there, Roberta, the kind of general exposure to physical risks, transition risks and opportunity as an example. So, take insurance. We know that there's likely to be a fair degree of exposure to physical risks or energy, transition risks and opportunities by comparison. So worth saying this does vary by geography. And then, of course, what source you're looking at. I think specific to the point around transitioning from TCFD to ISSB, again, there's a lot of regional variety here. And also kind of, it depends also on the kind of size of the company, the industry, the jurisdictional timeline, etc. And I think I saw a comment in the chat earlier around kind of how do you measure making the transition. So, perhaps one good proxy is to think about how the ISSB is being referenced in public disclosures. Are we talking here about kind of a general reference to the ISSB, as if to say, we know that regulations are requiring increased climate disclosure, or are we talking about kind of a stated alignment or a planned alignment, etc.? So a classic consultant answer to say it depends, but generally speaking, we're seeing energy, we're seeing insurance showing quite good maturity. And I think, am I right in saying, Roberta, that the progress report has some really nice statistics
Yes, I
maybe you
think
want to touch on,
that what you were saying in terms of industry is very much in line with the findings of our climate progress report. As Jeff mentioned earlier, we we revised the sample this year compared to a previous report prepared by the TCFD, but we kept the type of industries covered in the report, in the sample, consistent. And we have observed that for some of the 11 recommended disclosure, the highest level of disclosure is for companies operating in the insurance industry and in the energy industry. So very much in line with what you were saying. And talking about the status of climate disclosure, moving from the perspective of the different sector and industry to the perspective of the different geographies and size of the market, maturity of the market. Juan Carlos, I wanted to ask maybe from your perspective, given that you have been involved in the TCFD consortium establishments probably since early days in Mexico, whether there is any lesson learned from the implementation of the TCFD recommendation from the perspective of developing economies. So whether you have any comment to share maybe for those companies that are approaching disclosure around climate risk for the first time, and from the Mexico experience, you had anything to add to that?
Sure. First, that companies shouldn't be afraid that this is a process, and that at least in Mexico, authorities understand that first companies have to develop their capacity to report, and I guess that most jurisdictions understand that. In fact, it's built in the form that the TCFD and the IFRS 2 were conceived, that reports should evolve, and that's why there is so much help and support for companies. There is a lot of experience that companies can draw from, and as I said, companies should look at this as a useful tool to identify climate-related risks and opportunities, rather than just a requirement or a regulation.
Thank you. Thank you very much. Other helpful, I think, suggestion for how companies should deal with this journey, knowing that everybody is on a journey. And I think we have maybe time for a question also from a practical perspective of the daily job, maybe for Andrew, regarding, again, sorry, your hat as a former auditor and your role of linking finance and sustainability. One aspect that our listener would like to explore better is how the relationship with auditors in this phase is evolving. So, for example, there is a lot of discussion about connecting information in the financial statement, traditionally being audited by auditors, and the sustainability-related financial information that might also need to be assured depending on the different regulation in the different jurisdiction. Would you have any experience with this challenge on how to, I would say, communicate to auditors and deal on the aspect of the transition? Even though we had a separate webinar on this topic only a few weeks ago, so probably that topic was covered there, but just from your perspective of somebody dealing with that every day.
Yeah, absolutely. I was going to say, there was a specific webinar on this just a few days ago, so I don't know if the team can share the link to that one. But yes, if this is a question for you, obviously feel free to listen to that. I think Yeah, just in terms of working with the auditor, obviously I touched on it. I think there's a big push to get your auditors involved. I think the days of treating the auditors and locking them away in the basement and hopefully getting them to leave as quickly as possible are probably long gone, especially when it comes to sustainability stuff and the evolution that we're seeing here. A lot of this is new. I think from an audit perspective, a lot of them are grappling with their methodologies and things, especially around things like CSRD and how they're going to go about assuring that. And so I think working with them in the process, it's a learning curve for all of us at the moment. And I think the earlier you get them involved, the better. Obviously, in terms of, I think a question around, do you use the same auditor that you use for your financial information as well as for your sustainability or non-financial reporting? I think that's very much an individual company's decision. I think you've got to look at a number of factors there. I know from our perspective, obviously a cost is a big element, but also sort of there are synergies to be gained. Obviously, we've touched on the overlap that is naturally there between the financial reporting and some of the sustainability reporting now. And I think you've also got to look, if you are a company that is exposed to CSRD and the ISRS standards, obviously there's a requirement there for assurance as well. So thinking bigger picture, because obviously that goes broader than just climate change and brings in a whole variety of topics and looks at it from not just the risk perspective, but also from the impact perspective. If there are synergies to be gained there in terms of working with the same auditor that does your financial information, then it probably does make a bit of sense in terms of saving time and potentially saving cost as well. But I think you've also got to consider the fit with them. Do they have the capabilities? Do they understand your business? Do they have the appropriate skills, etc.? So there are a number of factors, and it's a more difficult decision to make than I think a lot of companies think. But what we are seeing is that a lot of people are exploring options and ultimately coming back to going with their financial auditors at the end of the day.
Okay, thank you. Yeah, of course, assurance and the development there is something probably to monitor, and that will follow then the improvement on the information disclosure. And in this conversation, I think some of you mentioned that in this transition phase, there is help available. In addition to the educational material, there are also some transition relief that have been included in the ISSB standard. And I think Jeff is partially responsible for the inclusion of those transition relief in the standard, because I think when the ISSB was developing IFRS S1 and IFRS S2, it acknowledged the need to help companies during the transition to the new standards and provided relief and guidance to make their life easier. I wanted to ask whether you could remind to us and to all the listeners which are the main relief and mechanisms that are available to companies that are in this, I would say, journey to transition to the ISSB standards.
Sure. Thanks, Roberta. And I think we also have a slide on this as well to put some of these transition ones up. But before I talk about those, let me just quickly sort of mention that the way I sort of think about some of what we've done at the ISSB and bringing together the work of the TCFD as well as the other investor-focused guidance that was out there, SASB, CDSB, integrated reporting. We try to bring that all together and really elevate the level of conversation to try to fully meet investors' needs. And in doing that, we often ended up putting in more specific requirements and guidance, working on enforceability, thinking about how to improve comparability, usability, understandability of the information. So, we recognize that we are asking more of companies than if they were just using any one of these sets of kind of our underlying guidance, that came from these other organizations. So, in order to support really also global application of our standards, we put in mechanisms that I think are built in on a permanent basis to sort of focus on proportionality, scalability, really trying to make sure that we're not asking more than we should of companies while still trying to meet the needs of investors. And Hannah mentioned a really important part of this, which is thinking about, our focus on investor materiality, thinking about that's one of the biggest proportionality mechanisms that we have built into our standards. But when we talk specifically about climate, we also ask for disclosures in S2 on things like the resilience of a company's strategy. We talked about how that's where we're seeing relatively low levels of disclosure right now. But one of the things that we're asking for there is that companies use an approach that is appropriate based on its skills, capabilities, and resources, as well as the exposure that the company has to climate-related risks and opportunities. So what that means is that a company could start with qualitative assessments and move to something that's more quantitative, more detailed, maybe more sophisticated in some ways, over time as appropriate for its circumstances and what its exposures are for climate-related risks and opportunities. But looking specifically at the slide here, looking at some of the transition reliefs, these fall into really, I think of them as almost like sort of like three buckets, in terms of like what's the scope of what we'd be asking for in that transition period, what is the measurements that we would allow in that period, and also the timing of reporting. And so, one of the things that we allow for is that companies could first start with climate, and then that would give them a chance to really think about their exposure to climate-related risks and opportunities in their value chains. And then once they've got that after the first year of reporting, a better sense of that, then the second year they could move on to fuller disclosures with respect to their other sustainability-related risks and opportunities. Another thing that we built in as a transition was that in that first year, since we've heard that companies have a difficult time getting their heads around scope 3, scope 1 and 2 and 3, that companies could choose to not disclose scope 3 information in that first year, even if it would otherwise be expected based on their circumstances and what the S2 requires. And so there's a bit of relief there as well. And also to the extent that any of the scopes, they happen to be measuring those with a standard other than the greenhouse gas protocol, which is the one that we require companies to use when using the ISSB standards. If in the prior period they were using a different method for any reason, then they would in that transition period be able to continue using that same measurement for their greenhouse gas emissions. And in fact, that is something that is an indefinite relief to the extent that that use of an alternative measurement approach for greenhouse gases is required by a jurisdiction that they're operating in. They could continue in that jurisdiction to use that alternative method and not have to remeasure using the greenhouse gas protocol. And then with respect to timing, there's a few things there. One of the things that we are asking, which we know is going to be a big improvement for investors, but is a bit of a lift from companies' perspectives, is we're asking for the sustainability-related disclosures to be provided at the same time that they're providing the general purpose financial reports. So not separating in time that information, but in the first year, we're allowing companies to choose a later reporting period, really aligning with either Q2 or half-year reporting. And then, and also in the first year, a company wouldn't necessarily have to produce comparative information. So if you're reporting in 2025 on 2024 data, you wouldn't need to also report 2023 data, but in 2026, then you could report that 2024 and 2025 data. So a bit of extended relief there.
Well, thank you for this overview. Very, I'll say, quick but effective on exactly the point that people will need to look at in the transition phase. And we have additional questions from the people that are listening about how you can overcome challenges in this journey, which tools we could use, particularly for companies that have limited resources. And when I So this question, I realized that, of course, one of the focus of the work of the ISSB in the near term is to continue to support implementation of IFRS S1 and IFRS S2 with different activities. Could be educational resources, could be other tools. So very briefly, Jeff, I wanted to ask whether is there any aspect that you would recommend companies to monitor about the work of the ISSB that could help them in this context of overcoming challenges and identify tools that could be helpful for them.
Yeah, absolutely. So one of the things I would definitely recommend is that the companies pay attention to our transition implementation group, what's called the TIG. This is a group of largely preparers that from around the world that have been gracious enough to spend time to discuss questions that come in. So anybody anywhere can submit a question about implementing S1 and S2, and then we will address those questions in various ways, including bringing them to the TIG for discussion. And so it's a public forum for discussing implementation questions. And frankly, we've already seen it be quite valuable for kind of highlighting opportunities to develop educational materials where there's some questions around what it is we mean in the standards, and trying to, or where can they find the information in the standards to get that guidance. But we've also seen it in our most recent board meeting, for example, flag some implementation challenges that could potentially warrant even additional board consideration. So it's a great way. It doesn't on its own change any of the requirements, but it is a way to steer companies toward a helpful conversation, help to see how to interpret the standards as they are written, as well as potentially flagging opportunities for us to make improvements in the standards if necessary. And just recently we've seen some of the discussions around, for example, how should companies be thinking about risk mitigation activities when identifying their sustainability-related risks and opportunities? And so really great discussion there. And these are public meetings, and there's nice summaries provided afterwards, and they come to their board meeting as well. So lots of opportunities to highlight that. But there are a number of really great issues. So I would definitely encourage companies to follow what the TIG is doing. And then we also have educational materials that we're developing, sometimes from the TIG meetings, but also just where we've heard that there are questions and considerations. Hannah already mentioned the materiality guidance that came out recently. And I think there were some questions in the chat about that as well. Just to be clear on that, we do have the same definition of materiality as, for example, the IASB. That's an aligned definition there. And yet, because the context in which you're applying that for sustainability-related disclosures is different, we have heard that it'd be helpful to have guidance on how to make those assessments. And a big part also of being able to provide material information on the sustainability-related risks and opportunities that companies have, including climate ones, related ones, is identifying what are those risks and opportunities that companies face. And so our materiality guidance that we recently put out, the educational material, helps with that first step to really what is sort of a two-step process, identifying what the issues are and then providing material information about them.
The release of that material was really timely, considering the phase we are at the moment. So thank you very much, Jeff, and thanks also to Anna, Andrew, and Juan Carlos for your insight. I'm sure that our listeners found that very, very helpful. So thanks to everyone that has listened. I just wanted to remind everyone that the few slides that we have used to support the presentation today will be sent to all participants after this webinar. And you can also contact us via email. But before we go, I would like to remind about some of the key resources that have been mentioned already during this webinar, so that you can maybe look at those resources to continue to stay informed about development. So the IFRS Foundation offers several programs to help you to be informed about development. So first of all, our website and our IFRS Sustainability Knowledge Hub that has more than 200 resources, both from the IFRS Foundation and from third party that are partners of the IFRS Foundation. Then the IFRS Sustainability Alliance, a membership program for education, tools, and peer networking. Then the Fundamentals of Sustainability Accounting Credential, or FSA, that instills the link between sustainability and financial performance. And finally, of course, our website at ifrs.org, where you can sign up for alerts. And then please remember that your use of our resources and participation in our programs also support our mission as a non-profit standard setter. So please stay involved with the IFRS Foundation, including through this webinar series. I'm sure that there will be other episodes, and you can follow our LinkedIn account and news update to learn more about the series covering a variety of topics. And if you really want to hear more about the work of the ISSB, you can also listen to the monthly ISSB podcast that cover development on different aspects of the ISSB work. So on behalf of the IFRS Foundation team, I wanted to thank you again for participating. And until the next episode, thank you all and goodbye.